China drove the global recovery last year, and the government is putting a lid now on inflation and the amounts of hot money flowing into the country. Our next guest says that China will raise rates by 1 full percentage point before this year is done. Shen Jianguang is with us now. He is a chief economist at Mizuho Securities. He has worked for the European Central Bank, the IMF as well, and he is joining us this morning from Beijing. Shen, thanks so much for joining us. We're glad to have you. What do you make, first of all, of the trade data that we got? I mean, it was less than forecast. So does it show that China's plan to tame inflation, to address that problem, is working?
Thank you for the invitation. Yeah, I think that's nothing to do with China's effort to contain inflation. The trade number, actually, if you look at more closely, we are still seeing record high export and imports. So I think even though the trade surplus is lower than expected, that's primarily due to these higher imports. So which actually indicated that Chinese domestic demand is very strong, so that China needs to actually do a lot of things to contain overheated economy.
So this is almost proof to you that the central bank needs to be as active as you think it should be, which is to say raising interest rates by 1% before the end of this calendar year.
Yeah, I think that they need really to close the negative real interest rate gap, which is close to over 200 basis points. So that's actually the reason why households, people now are shifting their savings to housing markets. I think that's also the reason why government cannot control housing prices last year.
How much of this component or the concern of the governments is based around food prices? How much is that serving as a motivation to try to control inflation?
Yeah, actually, some officials last year believed this only because of food price or imported inflation. But actually, the October-November data already clearly indicated that the core inflation, that inflation excluding food and also about energy, also was rising at a rapid pace. So that's actually, I think, already changed government attitude towards inflation. So that's the reason why we see another interest hike in December. So I think this is really the case that the monetary policy needs to be tightened to contain inflation pressure. Otherwise, we will see this overall, the price pressure is rising rapidly.
Shen, how much agreement do you think there is within the Chinese government about the right thing to do? I mean, we know that certain regions have actually been profiting from the hot money. How much of a problem is this going to be in reaching consensus?
I think this is pretty much now consensus in a way that China's primary target this year is to fight inflation. This is a message we get from Mr. Wen, the Prime Minister, and also this is a message given by the central bank in the first work conference in this year. So it's pretty clear. But actually, I think they are in a dilemma because if they hike interest rate, the interest rate differential against the U.S. interest rates are rising. So the government actually is hesitant to do so because they are afraid that hot money will inflow into China due to the rising interest differentials. So they are now actually trying to balance these two competing needs.
Yep, a tricky balancing act to follow. Shen, thank you so much for the time. Shen Jianguang joining us there. He is the chief economist with Mizuho Securities. He is joining us there from Beijing.